Hello students, today we are going to study about portfolio management and its strategies. We will be studying about active portfolio management and passive portfolio management. And after that we will be studying portfolio revision strategies, objectives, performance plan, holding period return. So let's see what is exactly portfolio management that we already discussed in our previous classes. Portfolio strategy is a roadmap by which investors can use their assets to achieve their financial goals. So we have seen different objectives are there for the financial investment. So strategies will provide you so how to invest and how to achieve those particular objectives which we have decided or the goals we have decided. So there are different objectives we studied in our first unit. So we have to use different strategies to fulfill them. So it refers to the design of optimal portfolio and its application. So far we have studied type of analysis we do, and we have seen how calculation is done, and through that how to choose the perfect optimal portfolio so that we can achieve the goals what we have decided. Now beginning with the active and passive portfolio management strategies. So if you see portfolio strategy, that's we have already seen this, and in this we'll study about two things. So coming to the active portfolio strategy, so an investment approach in which an investor uses a variety of forecasting and assumption techniques to determine which securities to purchase in order to achieve a high return. So here in active way of portfolio strategy, investor always look for different forecasting techniques and some assumptions regarding of the techniques to determine which security has to be purchased now so that to achieve the higher return in the future. Okay, in active portfolio strategy, it is like buy and sell securities with greater frequencies. So selling and buying will be very often. Okay, frequency will be very high as the investors seek to move available capital into more profitable stocks. A strategy that uses available information and forecasting technique to seek better performance than a buy and hold portfolio. So here investor will not hold the portfolio for the longer time. So trading of the security will be frequent. Now if you look the approaches which are used in active portfolio, one is a top-down approach, another one is a bottom approach. In top-down approach, so what happens is investor observe the market as a whole and decide about the industries and sector that are expected to perform well in the ongoing economic cycle. So if you look at present cycle or economic, you can analyze which sectors are performing well. And as per the expert's opinion or his knowledge or her knowledge, they can predict that in next 2 years or 1 year, this industry or this particular sector is going to perform well. Okay, so he uses this information. So after the decision is made on the sectors, the specific stocks are selected on the basis of companies that are expected to perform well in that particular sector. But in bottom-up approach, in this approach, the market conditions and expected trends are ignored, and the evaluation of the companies are based on strength of their product pipeline, financial statements, or any other criteria. So first thing is companies on the strength of their products, how the particular product is performing of that particular company or a brand, financial statement analysis of that company, or some other criteria. So it's all stresses that fact that strong companies perform well irrespective of the prevailing market or economic condition. Whatever condition, whatever circumstances, but good companies will perform better. That is all about bottom-up approach. This is two types of approaches in active portfolio strategy. Now, if we study about the passive portfolio strategy, so here investing strategy that tracks a market weighted index. So the idea is to minimize investing fee and to avoid adverse misconceptions of failing to correctly anticipate the future. So here the investor will be in passive in his approach, and he will not take huge risk and always wanted to minimize the risk or a loss involved. So it relies on the fact that market are efficient and it is not possible to beat the market returns regularly over time, and best returns are obtained from low cost investment kept for the long term. So when we were looking for the active portfolio management strategy, there the frequency was higher, okay, and the trading frequency. But if you see here, trading frequency is very less. And purchase at the low cost, keep it for hold it for a longer period, so that in long term it will provide you a higher return. That is what passive portfolio strategy talks about. And it relies on diversification to match the performance of some market indexes. Now the approaches, if you see, so first is efficient market theory, that is we have already seen. So relies on the fact that information that affects the market is immediately available and processed by all investors. So thus such information is always considered in evaluation of the market prices. Now coming to the indexing. So in this theory, index funds are used for taking the advantage of efficient market theory and for creating the portfolio. So the index fund can offer benefits over actively managed funds because they have lower than average expense ratio and the transaction cost. Now, the other strategies which are used, patient portfolio, aggressive and conservative portfolio. In patient portfolio, it involves making investments in well-known stocks, okay? And the investor buy and hold stock for longer period because it's in patiently managed. So the majority of the stocks represent companies that have classic growth and those expected to generate higher earnings on regular basis, irrespective of financial condition. So these company perform always well, and they think this company, whatever thing condition happen, they are going to perform well and be patient holding them. Now coming to the aggressive portfolio, this type of portfolio involves making investments in expensive stocks so that provide good return and big reward along with carrying big risk also. So this portfolio is a collection of stock of companies of different size that are rapidly growing and expected to generate rapid annual earning growth over the next few years. Now in conservative portfolio, this type of portfolio involves the collection of stocks after carefully observing the market returns, earning growth and consistent dividend history. So here investor evaluate each and all aspects of that particular stock. He studies about the market returns, okay? Then what is the growth opportunity available, and then the dividend history of that particular stock which is provided. So these are the active and passive portfolio strategies which are revealed in portfolio theory.